Welcome to vTalkInsight, Market Drivers Daily for January 26th, 2026. Geopolitics, AI infrastructure spending, and a surprisingly hot growth backdrop are colliding right now, reshaping how markets price risk across assets and regions. Let's unpack how defense rearmament, the AI Capex boom, and a broadening expansion are feeding through to portfolios. Geopolitics is shifting from episodic shocks to a structural reset in defense, alliances, and safe havens, and markets are starting to price that more systematically. Compared with earlier this week, when tariff headlines dominated, today the story is more about long-dated spending plans, contested supply chains, and a changing toolkit for hedging political risk. That backdrop is reinforcing a premium on defense assets, lifting gold and silver, and nudging investors to reassess dollar exposure and regional allocations. On the ground, defense rearmament is gathering real scale. European NATO members have agreed a new spending target of 3.5% of GDP by 2035, while in the U.S. a proposed budget of around $1.5 trillion would mark the largest year-on-year increase in defense outlays since the Korean War. CSG's €3.3 billion listing in Amsterdam, the largest ever pure-play defense IPO, jumped on debut and underlined that public markets see this as structural, not purely a Ukraine war trade. In the U.S., Castellion is building what it claims will be the world's largest hypersonic weapons plant and has contracts across all three major military branches, highlighting how industrial capacity, not technology, has been the bottleneck. Safe haven behavior has also evolved. Gold and silver have surged, with gold approaching $5,000 an ounce and silver at record highs, helped by both geopolitical tension and a weaker U.S. dollar on track for its worst week in about 7 months. Central banks are reinforcing that move, with large purchases such as Poland's 150-ton order, while exchange-traded products make gold easier to hold as a portfolio diversifier. At the same time, oil is no longer acting as a reliable hedge against political risk. So many allocators appear to be leaning more on precious metals and defense equities instead. Alliance politics and technology are tightly intertwined in this regime. European leaders talk more openly about strategic autonomy as U.S. tariff threats, disputes around Greenland, and fragmented responses inside the EU expose divisions and raise questions about long-term transatlantic cohesion. Ukraine negotiations remain stuck on territorial concessions, keeping a risk premium in European assets, even as some officials suggest a draft agreement may be within reach. On the tech side, export controls around ASML's lithography tools, scrutiny of Chinese deals for AI firms, and the complex restructuring of TikTok's U.S. operations are all pushing companies to rewire supply chains and regionalize production, especially in East Asia and in sensitive chip segments. For portfolios, the key watch points are the implementation of NATO spending plans, any breakthrough or breakdown in Ukraine talks, and whether gold and defense stocks continue to act as the primary geopolitical hedge as oil's role fades. Artificial intelligence has clearly graduated from a niche equity theme to a macro engine in its own right. Large allocators argue that AI infrastructure is not in a bubble, pointing to the need for hundreds of billions of dollars in data center and chip Capex to meet demand, even as some early-stage ventures look frothy. AI-related goods already accounted for roughly 42% of global merchandise trade growth last year, and hyperscalers are expected to spend more than $500 billion on capital expenditure in the first quarter alone, raising legitimate questions about the long-term payoff. The strain on power infrastructure is becoming a central part of the AI story. Data centers are emerging as major electricity consumers, to the point where governments are asking them to provide backup power during extreme weather events to help stabilize grids. At the same time, AI is expected to accelerate the development of new, cheaper energy sources and reshape global power infrastructure, creating a powerful link between AI Capex and the broader energy transition. This is why sectors tied to power solutions and grid reinforcement are increasingly mentioned alongside chips and cloud as beneficiaries of the AI build-out. Market leadership within AI is fragmenting. NVIDIA's data center revenue is projected around $350 billion this year, with management and analysts emphasizing that growth looks sustainable even without China because global AI infrastructure spending is so strong. By contrast, Intel has missed on earnings, faces strategic drag from geopolitical pressure to build a domestic U.S. foundry, and is seen as richly valued relative to its competitive position. Memory names like Western Digital and Micron benefit from data center demand. Yet rising short interest signals skepticism about the durability of their recent gains. Among platforms, Google's Gemini 3 model is outperforming peers on benchmarks and helping drive about a 70% stock gain over the past year, while Microsoft and Meta face growing investor questions about whether huge AI Capex can be monetized quickly enough. Underneath the headlines, AI is starting to show up in macro data and corporate behavior. U.S. productivity growth has printed around 4.9%, and analysts expect broader AI adoption to add 2 to 3 percentage points to corporate profit margins by cutting costs and lifting efficiency. That opens the door to a so-called jobless boom, where output and earnings rise even as job creation stays modest, echoing today's mix of strong GDP with softer labor markets. Views on employment diverge. Some expect near-term workforce contraction in less flexible roles, but current labor data show little AI-driven job loss so far, and there is rapid growth in new categories such as AI agent training, where one firm reportedly scaled from $1 million to a $500 million revenue run rate in just 16 months. Insurance, logistics, industrials, healthcare, and even media names like Spotify are integrating AI into operations, suggesting the theme is broadening well beyond big tech. There are, however, clear fault lines. Parts of the AI ecosystem look stretched, from startups raising large sums without products to unsustainably high compensation packages for elite talent, and some investors see this as a classic setup for a shakeout. Regulatory scrutiny is rising too, with China's review of a $2 billion AI acquisition and ongoing concerns that TikTok's U.S. data, including marketing and e-commerce flows, could still be accessed by Chinese entities despite new governance structures. Globally, the World Trade Organization projects only about 0.5% growth in merchandise trade for next year as tariff effects bite. Yet strong AI trade or durable truces between major blocs could surprise that to the upside. Meanwhile, concentration risk in a handful of AI leaders has already prompted some global investors to diversify away from U.S. equities and dollar assets, even as the U.S. remains attractive thanks to AI-driven Capex and growth. For markets, the next phase will hinge on whether reported productivity gains, power grid solutions, and earnings delivery justify today's massive investment cycle. The growth backdrop remains strikingly strong, especially in the U.S., even as central banks back away from aggressive easing expectations. Surveys show U.S. manufacturing back in expansion territory, with the latest PMI at 51.9 and the University of Michigan Consumer Sentiment Index at its highest level since last August, pointing to improving household confidence. Internal data from major banks highlight robust consumer spending and solid commercial lending, while overall GDP growth is expected to run above 5% in the first quarter, largely powered by AI and broader technology investment. Interestingly, this is happening alongside sub-100,000 monthly job creation, reinforcing the picture of strong output with a relatively soft labor market. Earnings expectations are catching up with the macro data. Forecasts for 2025 point to low double-digit profit growth, around 14.4% in some projections, and at least one major house sees the S&P 500 ending the year near 7,100, even while arguing that equity returns may look middling versus other assets. Market leadership is already rotating. Value stocks, small caps, commodities, and industrials have been outperforming megacap tech, and international and emerging markets are outpacing U.S. benchmarks. Within the S&P 493, industrials benefiting from AI, financials supported by the macro backdrop, and consumer discretionary names helped by tax refunds are attracting attention, with industrial earnings growth around 16% seen as more credible than some of the loftier tech forecasts. Beyond the U.S., growth is broad but differentiated. Upcoming PMI releases for the Euro area, the UK, and the U.S. will offer fresh reads on momentum, but we already know UK private sector activity is expanding at its fastest pace in 2 years, led by technology and financial services after policy uncertainty eased. Emerging markets are growing roughly 2.5 percentage points faster than developed economies, helped by earlier rate hikes and tighter fiscal discipline, and South Africa is a case in point, with a stabilizing debt ratio, a lower 3% inflation target, and projected growth of about 1.8% as reforms bed in. Other niche growth stories include commercial space, as private firms step in with cheaper access to orbit, and new consumer formats like customizable footwear platforms and the rapid expansion of TikTok Shop, which could reach $20 billion in U.S. sales this year. Policy and rates remain the key swing factors for this expansion. Markets now price only about 40 basis points of U.S. Federal Reserve cuts for the rest of the year, reflecting stronger growth and investment trends. Term premiums have risen on political risk, keeping the bond market under pressure even as equities stay resilient, and the dollar has logged its weakest week in 7 months, encouraging a reported 5% reallocation away from dollar assets last year. At the same time, a surge in productivity can actually stoke current spending as households anticipate future income, potentially lifting inflation and requiring higher real interest rates, especially if global trade growth slows toward the World Trade Organization's 0.5% baseline. With oil no longer a reliable hedge, gold's latest surge and continued demand for defense and infrastructure plays underline how investors are navigating this run-it-hot environment. The key watch points now are the next round of PMIs, central bank communication around that reduced cuts profile, earnings from cyclicals and small caps, and any escalation in trade or geopolitical tensions that could test the durability of the current rotation. Across today's themes, the message is that markets are pricing a more permanent shift, not a passing scare. Defense rearmament and fragile alliances are reshaping geopolitical hedges. AI infrastructure has become a genuine macro driver with clear winners and losers, and global growth is running hot enough to narrow the scope for additional rate cuts while still supporting a rotation into cyclicals and ex-US assets. Watching how earnings, power grids, and policy respond to this new mix will be critical for risk management over the coming quarters. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.